Hello, and welcome to the Aardvark tax conversation about the One Big Beautiful Bill Act of 2025. I'm Sean, a customer service representative and enrolled agent here at Aardvark Tax. And this is going to be a quick video that will talk about the upcoming changes to the tax laws that you should be aware of for the One Big Beautiful Bill Act and the changes it made. We do try to put out several videos a year, so please don't forget to subscribe. First, if you're watching this on YouTube and not as part of an Aardvark tax course, you're not getting credit for having watched it. So head on over to www.aardvarktax.com and order any of our 15, 20, or 30-hour courses so you can get credit for watching this with your governing agencies like the IRS and CTEC. So let's begin. And I need to start with a coverage disclaimer. The One Big Beautiful Bill Act was gigantic, and trying to cover every change in it would require a series of videos that no one could sit through while staying awake. So we're just going to cover the tax law changes as they relate to individual tax returns. So business subjects that relate to Schedule C will be covered, but some of the more weird changes applicable to corporations and other things won't. Still, many of the rules that apply to Schedule C will also apply to corporations, and some of the new business tax law changes are so specific and arcane, they just really don't belong in a video that's going to be for most folks. So, what does the One Big Beautiful Bill Act cover for personal taxes? A lot. So let's begin. We're going to break this up like this. What parts of the bill make the changes from the Tax Cuts and Jobs Act of 2017 permanent? What things have been revoked or repealed? What things are new and permanent? And finally, what things are new and temporary? As you know, I've had a countdown in place for the last 4 years for the changes in the Tax Cuts and Jobs Act that were due to expire at the end of the 2025 tax year. Most of these changes have been made permanent, so let's take a quick look at that list. First, the legislation makes permanent the 7 rates created by the Tax Cuts and Jobs Act and gives the initial inflation adjustment in 2025 for the lowest 2 brackets, 10% and 12%. Personal exemptions are now gone forever, and the higher standard deduction amounts are permanent and now indexed for inflation. Additionally, for 2025, the standard deduction amounts have been raised slightly higher than they were going to previously be set. The larger standard deductions and removal of the personal exemptions is a great change for singles and married couples with small families, as their deductions are much larger than they might have been before 2017. But for large families, this isn't so great. However, the bill does make up for that with an improved child tax credit. The higher values for the child tax credit that were introduced with the Tax Cuts and Jobs Act are now permanent and have been slightly increased from $2,000 to $2,200. Additionally, the related refundable portion of the credit is $1,400 and will now be adjusted annually for inflation. This phases out at the thresholds of $200,000 for singles and $400,000 for marrieds, and also are now permanent. Please note a significant change. The Tax Cuts and Jobs Act required a Social Security Act for the child being claimed, but the One Big Beautiful Bill Act now also requires that at least one of the parents have a Social Security number. Another credit that people have found handy is the Other Dependent Credit. It's now been made permanent, and it will continue to be worth $500 and is not going to be indexed for inflation. For those of you in the gig economy, the One Big Beautiful Bill Act made things a little less paperworky for you. Now, instead of your gig third-party platform being forced to create a 1099-K for you if you earned more than $600, that's been rolled back to the original $20,000 from a few years ago, and that's made permanent. Don't forget, this just means that your third-party app for platforms doesn't have to report your earnings to you or the IRS, but your taxpayers will still have to report any and all income that they receive, regardless of whether it has been reported or not. Speaking of business, the qualified business income deduction is also now permanent at 20%. This allows partnerships, S corporations, and sole proprietors to have some long-term planning certainty that they didn't have before when the QBI was set to expire this year. The phase-in amounts for the QBI have also been expanded. Some other notes about things that were temporary from the Tax Cuts and Jobs Act but are now permanent due to the One Big Beautiful Bill Act Yep, it's official for most taxpayers. No more moving deductions, no more tuition and fees deduction, no more job expenses deduction, or general casualty deductions. The job expenses deductions have been removed from Schedule A permanently, and the general casualty deduction is now permanently only allowed in areas that have had a federal disaster declaration. The tuition and fees deduction is gone forever, and the moving deduction has now been permanently limited to active military members. Also, mortgage interest is now permanently limited to the $750,000 set by the Tax Cuts and Jobs Act. But on the bright side, the provisions that allowed for employer contributions to student loans and the above-the-line educator expense deductions have now been made permanent as well. Additionally, there's an additional educator deduction available for those that itemize. Finally, the One Big Beautiful Bill Act makes permanent the high federal estate, gift, and generation skipping transfer tax exclusions. And the new basic exclusion amount will be indexed for inflation for subsequent years. Your taxpayers with large estates will benefit from this change, as it provides an opportunity to shift more wealth to their heirs free of transfer taxes. And because there is no sunset provision, it will allow the implementation of long-term estate and gift tax planning strategies with greater certainty for folks. Okay, let's talk about the repeals now. As you probably heard, almost all of the personal energy credits will be final this year and not continued into the 2026 tax year. This includes your household residential energy credit, which is still worth a whopping 30% credit for those who install energy efficient improvements before December 31st, 2025. Also repealed is the clean vehicle credit, but that one is gone sooner. Your taxpayers will only have until September 30th to buy a qualifying vehicle to get the partial or full $7,500 credit. So what's new and permanent in the One Big Beautiful Bill Act? First off, the Act limits charitable contributions for itemizers. Beginning in 2026, only contributions exceeding 0.5% of the individual's adjusted gross income will be deductible. While this affects everyone who itemizes deductions, this primarily affects taxpayers with larger incomes. The adoption credit, long a source of consternation due to its pay some tax or lose it credit status, has now been made partially refundable. This means even people who don't owe any tax can still get some of the credit as a refund. Up to $5,000 of the adoption credit is now refundable, and this amount will be adjusted for inflation. The Act also expands tax-exempt distributions from 529 plans. The amount for K-12 education has been doubled from $10,000 to $20,000. It also now allows for distributions based upon expenses for K-12 costs, such as books and tutoring. On to credits. The Child and Dependent Care Credit has been expanded to allow the amount to be claimed to be 50%, up from the previous 30%. Additionally, the credit will phase down at much higher income levels. The Premium Tax Credit, the credit that allows taxpayers to have a government-subsidized part of their health insurance, has been changed as well. First, its eligibility requirements are now much more restrictive, and household income levels required to receive the credit have been lowered. Additionally, there is now an expanded document requirement, which is designed to make the red tape of getting the credit much more difficult. And finally, in the scenario where taxpayers have made more money than expected, the limitation for the amount of payback has been greatly restricted. This means that taxpayers need to be much more careful about how much money they think they're going to be making in the coming year, or they will face a stiff repayment penalty come the next April if they made too much. If you have a business, you'll appreciate that the deduction and phase-out limits for Sections 179 expensing have been raised. And more importantly, that bonus depreciation is now permanent and set back to 100%. This is in direct contrast to the Tax Cuts and Jobs Act, which lowered the bonus depreciation amounts by 20% a year since 2020 or so. And effective for 2026, the reporting threshold for 1099 MISC amounts has been raised from $600 to $2,000. This means you do no longer have to report 1099 payments to the IRS for any amount under $2,000. The person receiving the money, however, is still required to report the income, whether it has been reported or not. Are you a gambler? If so, I've got some bad news. In the past, you could deduct 100% of your losses against any winnings that you may have had. For instance, if you won $210,000 but you lost $200,000, you would only have to report $10,000 of income. This has now been changed, and not in a good way for gamblers. Now taxpayers can only deduct 90% of their losses. This means that taxpayers may pay tax even if they've lost money for the year. For instance, if I lost $210,000 but won $200,000, I could only deduct $189,000 of it, which means I'll have a taxable income of $11,000 even though I lost money. Let the gamblers beware. Okay, let's close off this section by talking about new favorable tax rules for qualified small business stock owners. Prior to the enactment of the One Big Beautiful Bill Act, small business founders and investors who met certain conditions could exclude up to 100% of the gain upon the sale or exchange of qualified stock, but they had to own the stock for at least 5 years. The new act introduces a tiered exclusion for stock that no longer requires the full 5-year period. This act also increases the amount of gain eligible from $10 million to $13 million and increases the gross asset threshold that allows a business to be considered qualified. And now onto the new tax law changes that are only temporary. Sometimes temporary changes are put in place for incentivization purposes or to address some kind of crisis. And sometimes Congress is just being sneaky. They do it because they think it makes the overall cost of the bill look to be a lot less than it really is, or they're trying to stick it to the next administration, when those popular deductions and credits disappear right when someone new takes office. So with that in mind, here are the new tax law changes that will only last for the next few years. The first is a bonus addition to the standard deduction for those over 65 in age. This one will expire in 2028, and it allows seniors to take an additional $6,000 off their taxable income starting in 2029. And that's $12,000 for married couples. Keep in mind that this deduction phases out at higher income levels and that the seniors must have a Social Security number in order to claim the deduction. And just more proof that the married filing separately status is the worst filing status of all. You can't get the bonus deduction if you use it. Next, we have an increase to the SALT deduction for itemizers. The Tax Cuts and Jobs Act introduced a $10,000 limit for deducting state and local taxes, but the One Big Beautiful Bill Act makes that change permanent while still allowing for a 4-year period, whereas temporarily raised to $40,000. It phases back down to $10,000 for incomes of higher than $500,000. This deduction will return to the $10,000 limit in 2029 for everybody. If you're a worker who receives tips or overtime, you're going to score for the next 4 years. The One Big Beautiful Bill Act exempts overtime pay up to $12,500 or $25,000 for married folks. The deduction will be phased down and capped for higher earners and is, once again, not available to those using the married filing separately status. Tips can also be deducted from income up to $25,000 with a phase down and cap for higher earners. The taxpayer must work in a historically tipped industry. For both the tipping and overtime deductions, employers must still keep track of the earnings for Social Security and Medicare tax purposes, and the taxpayer must have a valid Social Security number. These deductions are good until the 2028 tax year. Looking to buy a new car? If so, you might be eligible for a new deduction for car loan interest. The deduction is limited to $10,000 of qualified interest, and the vehicle must have had its final assembly take place in the United States. It phases out for higher earners and is set to expire in 2028. Finally, let's close out our talk by discussing what are now being called the Trump Child Savings Accounts. The One Big Beautiful Bill Act introduced a new type of savings account for U.S. citizen children under the age of 18. Family members can contribute up to $5,000 a year, adjusted for inflation. The amounts are not deductible, but when the children grow up, all of the earnings on the account will be tax-free and can be used for education or for the first-time purchase of a home. Once the child is age 31, they can use the money tax-free for any reason at all. The federal government will make a one-time $1,000 contribution per child to a Trump account for U.S. citizens born during this next 4-year period, though the account itself can be created for any child that is under the age of 18. So did you notice? Every one of the temporary tax benefits we discussed expire in 2028. One final note to our California preparers, keep in mind most of these changes will not conform with existing California tax law, and there will likely be a lot of addition and subtractions on your Schedule 540 CA this year. Okay, that's it for our discussion of the One Big Beautiful Bill Tax Act of 2025. I hope it was helpful for you as you prepare for the upcoming tax season. Don't forget to run to www.aardvarktax.com to order your continuing education for this year. Our classes include courses for enrolled agents, AFSP program members, and California and Oregon registered tax preparers. Most of our courses are available in both online and printable versions. Feel free to call us up with any questions at 877-212-1384 and have a great rest of your year.